Hey guys, hope everything's going well. You guys know that drill. Smash that like button, subscribe if you haven't, and comment down below. Follow me on Instagram at AIH underscore sports. Okay. I wanted to revisit the topic of interest rates. I've been doing some digging on some older articles and I wanted to show you them. But before I do, I wanted to show you this again from vintagetextile.com. And this statement is probably the most important statement in terms of collectibles. And I will show it again. Fine collectibles respond to negative real rates by rapid appreciation. So when interest rates are negative, that is ripe for collectibles. It helps the collectibles markets. And as you can see here, in the 1970s, when the United States got off the gold standard, what happened was you had crazy amounts of inflation once that initially occurred. And we had these negative interest rates, which was bullish for collectibles. Okay. And some people, they may not agree with this. Some people say, hey, I'm not really sure about this. And then if you look at over here in the 80s when Volcker raised interest rates, interest rates are positive, and that wasn't right for collectibles. And I was doing some digging in some databases because you can't really find these articles on Google because it's not culturally relevant. I believe the algorithm on Google helps find articles that will basically get more clicks and more ad revenue. So I had to go through a database through my library, and I found this. There's a Chicago Tribune article from May 12th, 1981. And it says, collectibles dip as interest rates rises, inflation ease. Collectibles dip as interest rate rise. Okay, it says the same thing. Okay. So once again, this was when Volcker was raising interest rates like crazy. Let's just read it. High interest rates and easing of inflationary pressures in recent months are wreaking havoc on the collectible markets. Chicago banker and veteran collector of stamps, antique toys, leather-bound books, and 18th century French furniture summed up this quandary. How can I justify buying a stamp, even a top-grade one, that I know will appreciate over the years when I can earn 15% in the money market fund risk-free? Let me just interrupt here. Interest rates are not going to go up that much, money market funds, in our lifetime, in my opinion. But he's just making a point. Why would I be putting money in collectibles when I could get a higher rate of return? Let's continue on though. Dealers aren't faring any better. Not only are they seeing fewer customers, but high interest rates are making prohibitively expensive to carry interest rates of arts, antiques, or diamonds. Traditionally, the prices of collectibles like paintings, antiques, coins, diamonds, and stamps soar in periods of inflation as people lose confidence in the worth of the dollar. But when the rate of inflation eases or people become confident that it will ease, prices of tangible assets begin to drop as investors switch to stocks and bonds. Collectibles in general are doing very well at the top end of the market, where 18th century Newport style designers that sell for $350,000 can be found, but the prices of some modest pieces have fallen dramatically from the highs they reached during last year's speculative fever. Does that sound familiar with some sports cards? Granted, the interest rates haven't gone up. All right, let me continue. Less than a month ago, an example, a Tabriz rug bought from one of the Chicago's leading rug dealers for $10,000 was sold at an auction a few days later for $2,500. Well, that seems familiar for some of the sports cards that have dramatically gone down. Dealers say markets have stabilized somewhat, but apart from the exceptionally high ticket items, prices remain comparatively weak in almost every area. That means, however, that buyers willing to hold on for the long term may be able to find some good values. I'll read this last paragraph. Purchases of collectibles or refugee properties, as they are sometimes called in Europe, will buy when they see political or economic stability and high interest rates. Says James Gillespie, Vice President, Sales Division of the brokerage firm Smith, Barney, Harris, Upham and Company, Inc. Things like paintings, jewelries, or rugs will increase at a rate faster than inflation, so they protect themselves with the hedge. Okay, so that article was from the 1980s, and it said that interest rates were rising. And remember, interest rates were dramatically raised during that time. And everything was going down because inflationary pressures were easing. And I'm over here at the Fed funds futures, and you see a lot of headlines going on. But I tend to ignore what the noise is and look at what the traders are pricing in. So basically, if you just look at January, the Fed fund futures, January is almost over, but you take 100 minus this number. So it's less than 0.08. So basically interest rates are zero. That's what it means. So if you look at April, you take 100 minus 99.63. And that's what? 0.37. So it looks like in April, they're projecting a rate hike, sophisticated traders. So if you go, because each rate hike is 25 basis points, or supposedly. All right, and if you look at this December of this year, 100 minus 98.79. So that's close to 1.25. It's predicting almost 5 interest rate hikes. Do I predict 5 interest rate hikes? No, I don't. The reason is, some people are saying it's an election year. Yes, I agree with that. Now, that being said, because of the higher oil prices, because of the empty shelves, some of my friends from different parts of the country are telling me that the shelves are empty, okay, wherever they shop. They can't get the foods that they normally could have. So because of that, you see Twitter, people talking about empty shelves. So I believe the Fed's going to raise rates. Now, once again, I don't think it's going to be 5. It could be more like 2. But long story short, the Fed is trying to raise rates, in their opinion, or they will, to try to curb off inflation. Now, the inflation will not be gone by the end of this year. In my opinion, it could take potentially a few more years to raise to get rid of all that inflation. And if you look at it, it's talking about December 2023. It's going to be close to it could be close to 7 interest rate hikes. So yeah, it is what it is. So you take 100 minus 98.19, that's what? Close to 1.75, okay, and that's approximately 7 interest rate hikes. And by that time, I would not be surprised if the long end of the curve, you're going to see more push towards positive interest rates, because the way that sophisticated money works is they don't usually look at short-term interest rates, they look at longer term. And right now we have negative interest rates, as I've mentioned, negative 0.59. You see this go positive, that's going to be, in my opinion, bearish for commodities. And not commodities, collectibles, the whole 9 yards. And you saw, last time you saw a dip in the sports card market, collectibles, was in March of 2020. You had positive rates over here, okay? And some people are saying like, hey, you can't invest in collectibles. And I'm like, yes, you can. You just have to understand inflation. You have to understand the Federal Reserve. You have to understand how the monetary system works. In my opinion, you buy up here, positive rates, the most quality thing that you could find, and then you probably sell in an area where you have more inflation. Now, a lot of people may not get this concept, or they may not agree with me, but I'm just looking at various data. And some people are saying, hey, I just collect $20 worth of items. What you're saying is not pertinent to what I'm doing. I totally understand. I have a hobby of following financial markets. So this is what I like talking about. I like following sports cars. I like following sports. So I try to put it all in one. And I do believe that there's a financial component to understanding collectibles. And in my opinion, a lot of the channels out there, while many may be well-intentioned, they don't understand some basic concepts regarding the collectibles sports card arena. And it's concepts just like this, and the concept of liquidity, where many people, in my opinion, are not looking at. And in my opinion, a lot of people are probably going to get hammered, or their collectibles are going to dramatically drop in the next few years. We've already seen it in the past year, and interest rates really haven't gone up from the Federal Reserve. Just imagine when the Fed starts to unwind their balance sheet, which they are right now, and then raise rates. Okay. One last thing I wanted to show you. This is, once again, the 10-year tips. Is that this is, once again, a 5-year yield. Okay. But now this is showing the duration of the tips yield from 2004. I believe it was made in like 2003. And if you notice one thing, people used to say that, hey, collectibles really didn't go up dramatically in the real estate era. That's true. Look at where the 10-year tips was. It was always positive. It never went negative. It like started to go negative like in 2012-ish, right? And still the rates were positive. And then we saw this crazy run up over here with the pandemic, stimulus checks. We're all locked down, no sports. And now we're going to get out of this pandemic. So this money, or people are going to be out and about now. They're not going to be scared. So if you're not at home anymore, you're going out, you have less discretionary income for the collectibles market. So that's just one thing. But a lot of people used to say, hey, collectibles went nowhere. Yeah, look at the positive interest rates. It probably made no sense for people when the Federal Reserve kept interest rates higher than the 10-year. Okay. And probably November 2008 was probably one of the best times to buy collectibles. Those that did, and I see people making comments that they bought during this time, that was really, really, really smart money. I'm talking about smart money, dumb money. I've been dumb money a lot of times. But you're talking about smart money, these guys buying here when the market was crashing. Oh man, you guys are probably, you probably have hundreds and thousands of dollars in sports cards in your collection. Could be in the millions. So yeah, in my opinion, interest rates from an investing perspective is really important. And you have to remember, the older articles, if you just dig through this information, it shows that collectibles are not a short-term flip. Like you see a lot of these guys that flip sneakers getting into this, thinking that it's quick cash. No, it's not. Older articles stated that you need 5-10 years to get a good, rapid rate of return. And now the flippers are leaving. Now, in my opinion, we're getting it'll become more normalized. But that being said, there needs to be more pain before gain. One last thing I wanted to say before I leave, I did hear some rumbling about Star Stock. I'm gonna tie in Star Stock with some other things I want to talk about probably in tomorrow's video. Now, once again, I cannot prove everything that's going on at Star Stock, but it doesn't look good just based on looking at it. Anyways, guys, let me know what you think. Smash that like button, subscribe if you haven't, comment down below, guys. Thank you. Bye.